Our next guest built his career on shorts, but switched his strategy going into last year, just in time to catch the 30% run that we saw in the S&P. Joining us now is Bill Fleckenstein. He's the president, founder of Fleckenstein Capital. And Bill, great to have you back on the program. It's been a while.
Thanks for having me back, Betty.
Okay, and I know that you have not been very favorable on these banks. I believe you've called them black holes. You've questioned their accounting, say that they need to mark to reality. And as these guys, these CEOs, these four CEOs are getting ready to testify, do you lay the blame for all of the mishaps we've seen in the financial world on CEOs, on these CEOs?
No, it was sort of a two-pronged effort. The first irresponsible actor and the biggest was the Fed. The irresponsible interest rate policies and cheerleading on the part of the Fed, mostly in the form of Alan Greenspan, is what created the environment and the backdrop and the belief that that the financial entities could get away with whatever they did. So had it not been for Greenspan's policies, I don't even think, as drunk as these CEOs got in running their businesses, that we could have gotten to the place we did. But they are certainly culpable, and the first question they ought to be asked is, what in the world were you thinking when you allowed your balance sheets to get leveraged 30-to-1 when so many of those assets were illiquid? Stocks you can only borrow 50% against, right? So that's 2-to-1, and they're liquid. So the first thing you have to ask them is, what were they thinking, and what have they learned? Because it looks to me like they're trying to get right back to the same sorts of things.
But, Bill, you wouldn't realistically, of course, wouldn't really expect to hear an answer to that, right? Or an answer that would be adequate enough for you to understand these banks better, for you to look more favorably upon them.
Well, no, they'd have to change the accounting to really be able to understand what's going on. But I certainly believe that ought to be the first question that they're asked, and they ought to give a reasonable answer. And if they don't, they should be asked again. But I don't see how you can have any confidence in what's going on in those entities until the financial statements are clearer, and we get away with this, mark to model level 2 and 3 assets and all those sorts of things.
Bill, if they were to reduce the leverage, as you say, if they were to mark to reality, my question to you would be, what would we see then? What would we see in this banking landscape if that were to happen?
Well, the entities themselves would get smaller. I'm sure they'd be forced to take some hits because there are problems in asset markets that they're probably not reflected on their balance sheets. In all likelihood, that would create pressure as various different assets were liquidated. But we're going to go through that process anyway. And one of the big fallacies in this whole process has been, well, gee, we need to do things to prop up the real estate market because if we don't, bad things will happen. And I would suggest that trying to prop up the real estate market is the wrong thing. We need to get the assets down to where they can trade, to where people can afford them, so you don't have a situation where people are not paying. The banks are pretending that the loans are good, and we have this sort of limbo that we're in.